If you want to do that, to possibly invest passively first. That's the way to go. So invest passively in a syndication, meaning you're a limited partner or a passive investor in, one of these large deals. So basically you put your money in, let's say $50,000, and that goes towards, an equity pool in this larger deal, but you don't actually have to do anything. You're not active in the investment. You don't have to operate it. You don't have to acquire it. You don't have to manage the property managers or the contractors or anything like that. You just invest your money and you get a projected return back, and hopefully it goes well because you do give up control. Yes. But at least if you do invest passively first and you invest passively with the right people that might give you a peek behind the curtain, which is how what I was advised to do, that's a good first step if you want to be on the active side and you want to start raising capital for these larger deals.
You're listening to the Rich State of Mind Show, the podcast made to make you the total package in the entrepreneurial world and give you what we call a rich state of mind. If you are here looking to learn about real estate investing, marketing, elevating your business, and developing your mindset to get to the next level, then you are at the right place. Stay tuned and be sure to join our community on richstateofmind.com. Now here's your host, Anthony Ritchie.
Hey everybody, welcome to episode 75 of the Rich State of Mind podcast. We appreciate the support. This has been a great milestone for us, and we want to continue to provide more content that will service you. And also, as I've been doing these episodes, I've been learning as well. So definitely we've been living by the slogan, as you grow, we grow. So today we're talking to Seth Bradley. He's a real estate entrepreneur and an expert at creating passive income while working as a highly paid professional as a real estate attorney. He's the managing partner of Law Capital Partners, a private equity firm focused on multifamily and opportunistic acquisitions. He's a former big law attorney and is now managing the partner of his own firm, Bradley Law Limited, helping his clients and their real estate and asset protection needs. He's also the host of the Passive Income Attorney podcast, educating attorneys and other professionals on how to stop trading their time for money so that they can practice when they want to, not because they have to. So another syndicating episode. I like this episode though, because if you haven't yet figured out a relatable story, I think this would be one of them that you could relate to. I like being able to talk about different parts of real estate investing, but adding other people's story to it so that maybe you can kind of latch yourself onto their story to make you feel like, okay, I can do what they did, or at least take little bits and pieces out of their story to be successful. So please listen to this episode. Thank you for the support, guys. Please enjoy.
Hey, Seth, thanks for taking the time. This was long awaited. I mean, just as far back as a month and a half ago when I had my car exploded. So we were supposed to get up a long time ago, but I'm glad that we can actually talk and sit down. You actually be my last recording for a couple of months. Kind of backlog. It's kind of unfair to be telling people, wait 15 weeks till your podcast comes out, your episode comes out with me. So great that the one I've been waiting to do the longest is the last one. So if you could please just tell us a little bit about yourself, man.
Yeah, man. Appreciate you having me on today. Glad we were finally able to connect and get this thing recorded. Yeah, so a little bit about me. So I'm a real estate attorney by trade. I'm a real estate investor as well. Right now, I'm doing work for DLA Piper. It's the number 3 law firm in the world. I'm in their securities as well as their real estate department. But for the most part, I have transitioned into real estate investing full time, and I do the legal stuff just to kind of stay sharp. I started out in residential. Started with literally just house hacked into a duplex, and then eventually worked my way up into smaller multifamilies and into large multifamilies. And now we're syndicating deals, 200, 300 units and up.
Awesome, man. So let's peel it back a little bit and let's kind of talk about your backstory. So you said you grew up blue collar family, and so explain that process and what kind of led you into law.
Yeah, man. So, I grew up in a blue collar family. So my dad's a retired coal miner. My mom's a retired school teacher. And that's really all I knew growing up is that W-2 mindset, like get the best job you can possibly get. So I originally said, okay, well, what do I want to be? When I grow up, I want to be a doctor. That's the best job you can get in my mind growing up. So I went to med school for a little while. Went for a year and like 2 weeks before I dropped out because I just realized I literally got up in the middle of class and just left in my second year and said, this is not for me. I don't know what is, but it's not this. Ended up saying, at that point, well, what's the next best job I can get? And to me, that was being an attorney. So I went to law school after that, did well there, got a big law firm job. And at that point, everything was all good. I was a real estate attorney and I love real estate. I started investing, like I said, house hacking into a duplex and started buying single family rentals here and there, doing some fix and flips. All the while, I still kind of was in that mindset, like, I don't know how to get to the next level. Even though I'm closing these big commercial deals for other people, I didn't really know, I wasn't really over that mindset hump where it's like, well, I could actually close those deals for myself rather than being the service provider on the deal. So it took me a long time to kind of figure that out. I mean, that was back in 2013 when I started in law and started investing in real estate. And I just started investing in large commercial deals within the last few years. Isn't
that crazy how you could be right in the midst of it and it still feels like you're kind of so far away?
Yeah,
you see it, man. I'm pretty sure, one of the people that you closed the deal with, you could have at least probably, hey, can I get your number, or pull them to the side? And they might've been very willing to, share some information with you to get you started.
Yeah, absolutely, man. I think one really good example of that are like real estate agents and real estate brokers, because they're right, like that's their business, right? Buying and selling real estate. But if you ask them, hey, do you invest? I mean, 90% of them say no. They don't own any property themselves. They're just worried about the next transaction, even though they're in the middle of it. And they should look at every single property that they buy and sell as their own investment first. They should say, hey, maybe I should buy that. And then if it's not within their investment parameter, then maybe they sell it or they buy it for somebody else. But it's like, it's hard to get away from that transactional mindset into the, equity and long-term and building passive income over the long-term mindset.
No, you're right. When I was getting training from a real estate broker from Century 21, that was his biggest pet peeve, was trying to get his agents to invest in property. Because if I invest over time, I don't have to worry so much about the next transaction because I know I have my passive income and I have the MLS and I have a bunch of other marketing tools at my disposal in order to be able to be pretty successful and actually probably have an edge on a lot of other individuals. So I think it's a great one up.
Yeah, you've got all the tools in front of you and you have a one up on the next person. You've got the first look at certain properties and still you're not looking at them for yourself. You're looking at them for other people because you're worried about that next big payday instead of worrying about a long-term, steady drip that's going to keep you afloat and pay your expenses. And then you can take it to the next level.
Exactly. And so you said when you were working in big law, you have 2 aha moments. What do you mean by that?
Yeah. The first one, well, I'll rewind a little bit. It's going back to the blue collar mindset, the W-2 mindset. I was still stuck in that, even though I was closing these deals for other people. And these are these huge $100 million plus financings and closings for real estate. I was still, again, not really able to grasp that I can close those deals. So eventually though, I kind of got there and I saw those folks that were closing the deals. I saw the guys that are our clients that are closing the deals and they're just like you and me, man. They're just regular dudes, right? They're not, Donald Trump or somebody crazy like that. It's literally just guys like us closing these massive deals. And I was like, wait a minute, if these guys can do it and I'm helping them close this deal, then I should be able to do it too. So that was kind of the first aha moment when I started getting over that mindset shift and just thinking, well, I can do this. I just got to figure out how to do it. I've got to figure out the right resources, education, and network. And then the second one is really just seeing the older partners at the firm. They're 60, 70 years old and they're still billing crazy hours at the office, right? Like they're there before I am as a young associate. They're staying longer than I am. They're billing crazy time. They've still got all this other stuff they've got to fill in the gaps with, like, teaching other attorneys how to be an attorney, the administrative stuff. And it's just like, man, when does it stop? It's like, they're making tons of money, sure, but they're at an age where it's like, they've made their money and they still are at the office. Like, why aren't they home or retired or, doing the things they should be doing with their lives? And it made me just think, if I do everything right, if I don't screw up, if I bill all these hours, if I get clients, I bring the firm business and I just do everything right, the best case scenario is I end up like them. And I was like, that's not what I want either. So those were kind of the 2 aha moments where I started thinking even further, like, what else is there? And then that's when I started having that kind of entrepreneurial mindset shift.
So for you, what were your golden handcuffs? Because you talked about breaking free from them.
Yeah, for sure, man. I mean, I bought that duplex the first year. That's not golden handcuffs. That's an investment. That was a great investment. But at the same time, when I bought that duplex, I also bought a brand new 5 Series BMW. And it's like, that's golden handcuffs. That's like a $70,000 car when I had no business buying one at that point in time. But it's just like, you kind of get in that mindset. You're working all these crazy hours and you think you deserve it. You're like, okay, I deserve to buy this car and to spend this money because I'm working so hard. And that's not the right way to think about it.
No, I agree. I have a lot of examples of individuals that were older than me that when I was younger, they were like, hey, I'm 40, right? I should be living like such and such. But it's like you didn't do the proper steps in order to get there. And so maybe that 25 or 30-year-old is, let's say, driving that 7 Series BMW. And you're like, hey, I'm 37, I'm 40. I should be driving that too. But
Right.
You didn't do what you were supposed to do those 15 years or 20 years you've been outside of your parents' home in order to earn that 7 Series BMW. So I call it like skipping steps. You skipping steps to success, and then you end up getting pinched because maintenance on a BMW or Mercedes, cars like that, will come back to bite you if you can't properly take care of them.
Yeah, exactly. You skip the steps, man. You said it right, man. Instead of buying that BMW, you should be buying another investment property. And then maybe if you really want that car, then have that investment property pay for the car, but not just straight to the car.
Good rule of thumb, and I want to make sure I say this right. Dave Ramsey talks about this all the time, not to have a car that is worth more than 10% of what you're worth. Yes, because the idea is that if the car was to drive off a cliff, that you can replace it in a day. Like, it shouldn't impact you where you're like, oh my God, I have to buy another $70,000 car again. Most people wouldn't be able to do that the next day, Right. So that's kind of how I kind of think of it too, because I'm big on buying hoopties and building them up from scratch and working on them. And so that's kind of why I thought it was kind of funny. My car kind of exploded because I'll never be able to convince my daughter now to, get a hoopty and fix it up. So and it actually ended up being a recall, actually. So it wasn't my fault. But
there you go.
So let's talk about, you said you bought a duplex first, right?
Yeah.
So let's break that down. How much was it? What was your experience when you between you and the seller, right? What was the acquisition piece about? And then, what was it cash flowing?
Yeah, I mean, at that point in time, I didn't know a lot. I mean, I knew that real estate was a good investment. I knew I wanted to get into it, but I didn't know enough to, do a big rehab or anything like that. I mean, I bought it and it was turnkey. It was a turnkey duplex. It was ready to go. I think it was $250,000. I think I rented one half out for like $1,500 a month, and then I lived in the other half. So, it basically paid for, I was basically living rent free at that point. The mortgage was about the same. But again, it was turnkey. So there were no issues. And I actually still own that property today. It's a great rental. So, that was the beginning of, so that was the beginning of everything. So my first few properties were similar. I either, I moved a couple of times for different jobs. I moved to Charlotte and bought a house there and lived in that, ended up renting that out. Did a couple more of those and also picked up some other single family rentals along the way. But for the most part, they were turnkey. They were in good shape. They were ready to go. And then I started investing in other markets, also in Charlotte as well. So Charlotte, Cleveland, some other places where I started doing some heavy rehabs. And these rehabs turned into like, $100,000, $150,000 in rehab budget flips.
So great that you invested in Charlotte. That's actually been a great market in the last 10 years. It's really done very well.
Oh yeah.
And what made you start off with turnkey?
Again, because I didn't have the experience, man. It was my first few properties, I should say. And I just didn't have the experience. I didn't have the confidence yet to undertake a big, at that point in time, like for instance, my second property, building a deck was like a big deal. And I actually ended up building it myself. I didn't even hire somebody else to do it. I did it myself, but it was like, that was a huge deal. Like nowadays, that's like a joke. First of all, I obviously wouldn't do it myself. And second of all, it would be like, who cares? It's a deck. Like, yeah, we need to put a deck. We need to put a new kitchen. We need to pop a top, put a second floor on it. Like that kind of stuff nowadays doesn't scare me. But at the beginning, so if you would have said like, let's pop the top off of a single family house or a single level house and build a second story on it, I'd be like, man, you are crazy. I am not doing that. But nowadays it's like nothing really scares me.
Okay, so let's talk about that then. What was your first rehab? Was it like a burr, or it was just straight like you just renovated it, and then what'd you do with it?
Yeah, it was a burr, really. It was the first big rehab was one in Cleveland. It was a duplex. It was going to be a cash flowing property, and we actually still own that one as well. I'm trying to think what the rehab budget on that one was. It was a lot. It ended up being like $125,000 in rehab budget, and we only bought the property for like $90,000. So $90,000 purchase price, put in like 125. Right now, I think it's probably worth close to 350,000. But it's a great rental. I mean, we cash flow after, your mortgage, your insurance, your taxes, maintenance, all that kind of stuff, property management. We pocket about $1,300 to $1,400 a month for that.
And that's awesome. That's net. So that's awesome. That's the
Net,
power
yeah.
of burr, by the way. And for those that don't know, burr is buy, rehab, rent, refinance, and repeat. It's pretty popular in the real estate game. It's actually what helps a lot of people amass wealth very quickly. Because you can did you use a hard money lender?
Yeah.
Okay. So yeah,
a lot of people
use hard money. Let's say I put 10% down. Some people use, if you have a great relationship with hard money lender, 0% down, but let's say use 15% down. They cover the rehab. You got to pay points or interest until you get the job done. Usually, hopefully you get it done between 3 to 6 months. It's not something that's, excruciating. And then it's basically paid off. So you just refinance it, and usually right now you get loan to value, or you get about 70% now. So right. 70% of 100 grand, you get the 70,000. Let's say you only put 40 grand into it. And that's great numbers, by the way. That's very cheap. So that's probably like Detroit, Michigan numbers, but just for easy math. Now, since you put in 40, you got 70 back. Now take that other 30 and go use it on something else. And that's where the rinse and repeat come from. So it's a pretty cool method. I mean, I love it. We're actually about to do one now shortly. That'd be the last thing I do before the end of the year. I try not to bog myself down too much because I still have my 9 to 5. So I still have to do that. But
yeah.
So what made you, so you talked about other markets. And so it sounds like you went in stages. So you did your turnkey. And I respect that, right? Coming into the real estate game with turnkey, you don't have to worry about CapEx too much. Probably put a little aside for repairs and obviously vacancy. So kept it pretty simple. And then you went to renovating, huge renovations though, 150, but everything is done. Yeah. And so after that, what was your next step? Was it going and investing out in other markets, or that's when you started going to commercial property?
Yeah, I mean, that's when I started looking at commercial properties. I mean, I did a number of flips, a number of, buy and holds that had some heavy renovations on it. And then I started looking at trying to go bigger. We started looking at okay, how do we buy an apartment building? How do we do that? How do we do this? And I kind of wanted to skip. At that point, I realized I did have that mindset shift, and I wanted to skip the smaller stuff. I went directly from, single families and duplexes and fourplexes to, how do I get to like 100-unit apartment complex? So I started networking, trying to figure that game out, educating myself, and just really talking to people. And for the most part, most people will tell you if you want to do that, to possibly invest passively first. That's the way to go. So invest passively in a syndication, meaning you are a limited partner or a passive investor in, one of these large deals. So basically you put your money in, let's say $50,000, and that goes towards, an equity pool in this larger deal, but you don't actually have to do anything. You're not active in the investment. You don't have to operate it. You don't have to acquire it. You don't have to manage the property managers or the contractors or anything like that. You just invest your money and you get a projected return back, and hopefully it goes well because you do give up control. Yes. But at least but if you do invest passively first, and you invest passively with the right people that might give you a peek behind the curtain, which is how what I was advised to do, that's a good first step if you want to be on the active side and you want to start raising capital for these larger deals. So that's what I did. I invested passively in a few multifamily deals before going out on my own and partnering with other people to raise capital for larger deals on the active /general partner side.
Oh, that's awesome, man. You're the first person to actually bring that up as an option. I've heard one say, hey, be a real estate broker for commercial properties, and kind of that's how you could get your way in. And they would use their commission as a broker in order to, as leverage. Hey, look, I'll run it. I'll put my commission as, my part of the deal. And then obviously I need another 2 million for the rest.
Yeah.
But you're the first to talk about being a very passive. And then also too, and correct me if I'm wrong, but usually with those syndications, these investors, they're not looking to get their money back within maybe 2 to 5 years, or all their money back plus interest.
Typically, yeah, they are. I mean, typically that's your, I'll call it your standard typical deal nowadays. Investors are looking to get their money back in 5, it's usually a projected 5 years, possibly 7 years. However, there are syndicators out there that have, a longer term approach where they're like, okay, we're going to refinance and give you a big portion of your capital back as soon as we can, maybe at the end of year 3, maybe at the end of year 5, whenever the property can stand it. But we're going to try to keep this property long-term. So at least like 10 years, maybe forever. Maybe we're going to keep refinancing out, keep giving you more capital. You get to stay in the deal, but don't expect us to exit the property, as soon as possible, in year 5 or whatever. And you get like, this big, huge bump. Basically, you would double your money in 5 years is usually what people promise. But I like that longer-term approach. Yeah.
And so if I want to, syndication period, but let's say I'm going to take your advice, Seth, and I want to start being a passive investor, where do I start? Where do I kind of look to be a passive investor for these type of projects?
Yeah, I mean, I think it starts with networking. A lot of people don't even realize these types of deals are out there. I mean, it's relatively new to the public because in 2012, there was the Jobs Act, which made you be able to, which allowed people to solicit and advertise for these types of deals to bring in investors under certain SEC rules. Prior to that, you had to know people, like you had to be like part of this country club, and then maybe a couple guys there syndicated deals, and they could tell you about it kind of under the radar. After 2012, now there's a bunch of different rules, but you can basically advertise and solicit people to get investors. So that's why it's more widely accepted and more widely available to the public. So it really starts with networking. I mean, you need to find these sponsors, these operators. Maybe you go to local meetups. You'll definitely have a couple of people there that syndicate deals. Look online, get on LinkedIn. LinkedIn is where you can really find a lot of the operators. Get on their mailing list, let them start sending you their deals. Get on phone calls with them, talk to them, and educate yourself with, the books and the podcasts and stuff like that until you feel comfortable enough to pull the trigger, because, it's a high barrier of entry as far as finances are concerned, because they're usually $50,000 minimums. Now you might be able to find one that's 25, but for the most part, it's going to start at 50. If they have trouble raising the capital, they might lower it to 25.
Gotcha. And so you mentioned in your kit about 5 things syndicators need to know about their operating agreement. I'm glad that you have this as one of your topics to discuss, because I truly believe in having a thorough operating agreement. So please tell us what is your 5 things that we need to know?
Yeah, I mean, this one could probably take a long time, so I'll just go through it pretty quickly. I mean, so the operating agreement, especially with respect to syndications, more specifically with respect to syndications, is attached to your private placement memorandum. So that's basically your disclosure document that you're going to get from that sponsor, basically telling you all the bad things that can happen. It's going to say this can happen, this can happen, this can happen. And that's legally what they have to do. Now, attached to that private placement memorandum is going to be your operating agreement. And an operating agreement is going to be similar to, any other operating agreement, with respect to, the operations of the LLC. And here it's talking about the LLC that owns the property. There are 5 things that you definitely need to take a look at in that operating agreement when you're evaluating the deal. The first one is called a capital call. And if you're not familiar with that, that's kind of the worst thing that can happen in one of these syndications. What happens is, the property is in trouble. It's not cash flowing. They need to pay their bills, and there's no money to pay those bills with. So maybe they can't pay the mortgage on the bank note, something like that. They're in trouble. And what they have to do is do what's called a capital call. And they have to go back to their investors, the passive investors, and say, look, the property's in trouble. We need some more money. You either have to give us more money or you're out of the deal, which is extreme. That doesn't normally happen. And if that deal says that in the operating agreement, you don't want to be part of it.
Yeah.
Or most likely what it's going to say is you can put more money in and we want you to, and you'll get the benefit of that added cash. But if you don't, your shares are probably going to get diluted a little bit because other people are going to put the money in if you don't, so that we can pay these bills. So capital call, it doesn't happen very often. I heard of a couple of them happening during the pandemic, but it's kind of a worst case scenario because the sponsors don't want that. I mean, that damages that relationship with the passive investors because it says, we need more money in the middle, and you've already wired them your $50,000 or your $100,000, and they're asking for more just to stay in the game. That's not what they want to hear. So you want to avoid that at all costs, but there will be a capital call right in that operating agreement. You need to make sure you understand it. The second one is distributions. One thing to point out with the operating agreement is the private placement memorandum, and then maybe let's say a sponsor does a webinar or they give you some marketing materials, whatever it might be, it might have kind of your projected returns in it, but the operating agreement is also going to have those projected returns. And if there's any discrepancy between what the operating agreement says and any other document says, the operating agreement wins. So that's why you have to really examine the operating agreement.
Gotcha.
So make sure you know how the distributions work. Make sure you know who gets paid first. Make sure you know what fees you're going to get paid or you're going to have to pay. And that's the third thing is the fees. And it's kind of related. You want to see who gets paid what and in what order. So those things, the distributions and the fees, those things are very important. They're going to be in your operating agreement. And again, you have to check that operating agreement because that rules the day over any other marketing materials or anything like that you might see. Let's see. The fourth thing is liquidity. So one thing you have to know when you're investing passively in one of these deals is it's illiquid. Like you're not going to get your money back until you exit the property. You're going to get your cash flow. You're going to get maybe a big portion of capital back when you refinance. But at the end of the day, if you're like, I have an emergency, I need my $50,000 back, it's going to be very difficult to get that back. You're going to have to go to the sponsor. There's going to be some rights of first refusal. You're going to have to jump through some hoops. And maybe if they can move some things around, you might be able to get out of it at like a discounted rate. So you just want to make sure you know that it's illiquid and then look at the operating agreement to see what those liquidity rights are. The fifth and last thing are voting rights. So as a passive investor, you're not going to have that many voting rights, but you do want to look up that section in the operating agreement and see if you have for instance, the right to vote a manager out. So if the manager is doing a bad job at operating the property, you want to be able to get them out of there. Now, it might take a super majority. It might take 67%, 75% to vote them out, but you definitely want to have that because if they're doing an absolutely awful job, you can probably get that super majority to get them out.
I'm glad you mentioned about the manager piece because it made me want to ask the next question for the audience is the team. You're obviously not doing this all by yourself. Who are your teammates to acquire the deal and then to operate it?
Yeah, I mean, every team is different. There's some big pieces to a large deal like that, though. There's going to be somebody that finds the deal, right? There's somebody that has either the relationship with the brokers or the owners or whoever finds you the deal. So that deal finder is a big piece, and they're going to get a big piece of the equity just for finding the deal. There's going to be the operators, the main people on the deal, which typically they probably find the deal too. But they're going to be also the ones that are going to find the financing, put the whole team together, find the property manager, find the contractors, all that stuff, and actually usher the deal to close. So they're kind of like the main sponsors or the main people on the deal. Mm-hmm. They're probably going to be doing most of everything else as well. So anyways, you get a finance, you get the deal closed, you do the due diligence, the underwriting, all that kind of stuff, close the deal. And then after it's closed, you've got someone called the asset manager. Sometimes that main sponsor might partner with somebody else that does the asset management. And what the asset management does is they kind of manage the property manager, they manage the contractor, they manage the property to the effect that they just make sure everything's on point. Like everything is getting done when it's supposed to get done. The tenants that are moving out, you're getting the rehabs done on the units, and you're getting new tenants in there for the right price, for the projected returns to get hit. And those are kind of the main people at the deal.
And then, so what's a general rule? Because I'm pretty sure it's based off of each deal, but you going in as a syndicator, what would be kind of your general rule of thumb of how much equity you would want in a deal?
From the general partner perspective?
Yes.
Yeah, I mean, your typical split in one of these deals, baseline, let's call it, is 70-30. 70% going to the passive investors, 30% going to the active investors. And then that active investor piece, that 30% that's left over, that gets split up amongst that team, amongst those folks that I just mentioned before.
Gotcha. And so why do you consider syndications worth it when you have to split it up so much? And vice, you doing your own burr by yourself and it's all your cash flow.
Yeah, I mean, that's a great question, man. It has to make sense. It's got to be a big enough deal to syndicate it. It's like, okay, if I'm going to buy a 200 unit apartment complex, I'm going to need some capital. Let's say that 200 unit apartment complex is $10 million. You're probably going to need about $3 million in equity out of pocket that's not going to get financed. So you either have that $3 million in your pocket, which would be awesome, probably not, or you partner maybe with somebody else that does, maybe one or two people, and then you can do just, a smaller agreement, not syndicate it. But typically you're going to have to bring a lot of passive investors into the deal. And that's that's a syndication, because you need that equity. You need somebody to pay for it. Now, you're right. It's a good question as to when you should do it, or what the preferred method to go is. I mean, if it's, $2 to $4 million nowadays, we look at those properties and we're like, okay, we're not going to syndicate these deals. We're going to take those deals down ourselves, or we're going to partner with one or two people that are going to bring some equity in so we can close that deal. And we don't have to give 70% of the deal away. Maybe we'll just give 20% of the deal away, or something like that. Money partner will come in. We'll give you 20%. You don't have to do much. You stay involved, and that's about it. So it's a good question to ask. But, when you're talking about these larger deals and we're talking about scaling, because, it does turn into pretty passive. Like once you get it closed and you have an asset manager that handles all that stuff on the backside, you can keep doing deal after deal after deal after deal, rather than, a single family house where you're just, you got to manage these property managers and manage these contractors that are just, they're lower level vendors. You know what I mean? When you start dealing with these larger properties, that's the biggest difference, is you're dealing with contractors that are top of their game. They're worried about their reputation and they value their reputation. So they're not going to nickel and dime you for, $20, or, skip a few days, or say that they're sick or this. They get the job done because they want the next job.
Exactly. And so, to your point, man, $2 million deal, $12 per square foot, maybe your net operating income is like 160K, and you chop 70% of that, right? And then maybe now you're down to like 40K, and then you got to split between 5 people annually. So like now I did all that work and then I'm making 10 grand a year, maybe. Right. So I was like, that's just something to keep in mind. Like if like you said, take it down yourself. You probably can find a couple of people, especially if you network properly, to take down a deal like that by yourself. And then, like you said, maybe $10 million is when you need to start syndicating for it to be worth the hassle. Because, and then to some people, $2 million deal is a lot, but it is not worth involving that many people into it. And then obviously, depending on what your market is, how $2 million will stretch differently. $2 million is probably a quadruplex in New York or LA, but $2 million in Virginia or even Charlotte can probably get me a 15 unit, 15, 20 unit. So it depends on how you want to splice it, or, what you want to get into. But thanks for answering that question, because I'm pretty sure, like, as people's listening, it's like, well, okay, well, what should I syndicate? Because like $1 million deal is like pretty big for me,
Right. Yeah, no, for sure, man. And I mean, I do multiple prongs. Like, like I said, if it's, $4 million or under, we're going to look at it like, we're not going to syndicate that. We're going to try to take that down with a couple of money partners. But if it's a bigger deal, let's syndicate it. If it's still a great deal, we need to figure out a way to get that thing closed. And if that entails giving 70% away to some passive investors, so be it. Let's take that thing down.
That's awesome. And the 70-30 split, I think is pretty fair, especially if I'm assuming in these situations, you, outside of probably paying for lawyers, you're not putting much into the deal.
That's right. I mean, there's definitely at-risk capital. So, like upfront, before you raise the capital from the limited partners, you've got to come out of pocket a couple $100,000 for these big deals to pay for lawyer fees, to pay for due diligence, to put the deposit down, all that kind of stuff. So you're out of pocket, and that is quote unquote at risk, because if the deal doesn't close, you lose the money. But eventually, you get paid back for those sorts of things at closing from the investor dollars, because that's part of the closing cost. But yeah, I mean, you don't necessarily as a sponsor have to be out of pocket on those deals. So there's your advantage right there, is that you can actually get into these deals as a sponsor, as a general partner, and you actually don't have any money out of pocket, maybe temporarily, until you get close. But after that, maybe you didn't put any money at all. Now, I don't advise that, especially for passive investors. From their point of view, they want the sponsors to be involved in the deal. They want an alignment of interest. They want you to invest in the deal that they're investing in. So that's something you should look for. But technically, no. I mean, that's a really good advantage of being a general partner, is you don't necessarily have to come out of pocket any money at the end of the day.
And so I asked that question because I generally don't believe in no money down. You know how I'd be like, no money down, you get these deals. Like you're coming out of pocket at some point. Now, like you said, you will get the money back, a lot of it back on closing costs, but you got to have the money to begin with. Even for some of these smaller properties, you're still paying $500 for inspection. You're still paying for termite and moisture. You're still paying for somebody to come through and check especially if it's like a renovation, right? You're paying for if you are a good real estate investor, I believe in when I have my contractor come through, I was still paying for his time, even if I had to end up not even buying the place. So you are still forking up some money, right? Up front. So, cause I think the perception is that, if I got investors, I ain't got to touch anything. It's just I have the idea. So therefore I own half of everything just because I found the deal. When it's not the case.
Yeah. Now, I will tell you that kind of reminds me of something though. Like if it is a smaller deal, let's say it's a couple $1 million or something like that, a smaller commercial deal, a couple $1 million, $3 million, and you have some investors who are like, your friends or your acquaintances and stuff, and you kind of JV on that deal, you partner on that deal together. I mean, you don't have to split. And I kind of mentioned that before. You don't have to split at 70-30 at that point. You know what I mean? You can, on these smaller deals, it's a little bit more flexible because there's not an expectation. I mean, when you do these big syndicated deals, if you get into this game, you'll see that passive investors expect that 70-30 split. They expect some sort of a preferred return. They expect, certain projected returns. But when you're talking about something smaller, where it's just a handful of people, 2, 3, 4, 5, 6 people, you can divvy up that deal however you want. If you need $100,000 from a guy and he knows nothing about real estate, but he wants to get involved, you can be like, hey man, for that $100,000, I'll give you 20% of the deal, not 70%. And that's fine. It depends on, it's situational.
Yep. And I totally agree with that, man. And so one thing I've really been appreciating us discussing real estate. And so I want to discuss, man, your podcast. I think it's a very exceptional podcast. You've only up to episode 50, and I feel like you got a lot of traction very quickly. You've been doing it for about a year now, right? You just hit a year mark.
No, not even, man. Just since the end of December.
In December? Okay. So yeah, very quickly. And very impressed, man. Like I said, I've always liked your setup. And so let's talk about that. First, what got you into wanting to do a podcast? And what's it called too? Make sure we say that.
The Passive Income Attorney Podcast. I just really wanted to reach more people, to get more people involved with, investing passively, because where I came from, which is a big law firm, I started doing the fix and flips and all that kind of stuff while I was working. And man, it's tough. You have a 9-to-5, you said, and you're still doing all this real estate. It's difficult to figure out how to do all that stuff. So especially for folks that are like, a doctor or a lawyer or somebody like that, they have a really high paying job that they don't necessarily want to leave, but they do want to invest in real estate. Passive investing is a really good way to get started. Even if down the road, maybe you want to switch to the active side because you like real estate so much, passive investing is a great way to get started, especially if you make a lot of money and you have some expendable income to put into these deals. So I wanted to bring that back, especially to other attorneys. And that's really who my podcast is kind of marketed towards, although it's marketed towards, any real estate investor or passive income investor. And I just want to start giving back through some sort of a platform.
Okay. And so let's talk about some things. How did you market it? How did you get it to, where it's at today?
Yeah, I actually got a mentor / coach to help me launch this thing. Even before that, he was telling me, dude, you've got to launch a podcast. You got to do a podcast. I'm like, man, I don't want to do a podcast. Like, I don't want to be on camera. I don't want to hear my voice. I don't want any of that stuff, man. I just want to put my head down and buy some real estate. And he's like, if you want to get passive investors and you want to actually help people, then you've got to get out there. And the best way is a podcast. So I said, all right. So I ended up doing that through his advice. And the guy's name is Adam Adams. He's really good at like marketing, podcasting, anything marketing related to real estate investing. He's a master at it. And he told me, you've got to record a ton of episodes, first of all, and launch a bunch of them on day one. So I launched 5 on day one. And after that, I did one every single day until day, I believe like 20 or 25. And then after that, I went into my regular cadence, which is once per week. And that really helped me launch strong. Like I had like 10,000 downloads in the first month because of that strategy, because I was able to, instead of just launching one and then waiting a week and launching another one and waiting a week, people had a bunch of material to listen to. So if they liked it, they just kept listening because there was more material already out there. So I got a lot of momentum by doing that kind of, multiple episode release at the beginning.
I never heard of that before. So that was his reason for telling you to do that. Hey, give everybody something, a big, bite to chew off of in the beginning, and then you'll get your momentum from there.
And the other thing is you hack the algorithms that way too. So you hack the algorithms like Apple Podcasts and some of the other ones. If you get a lot of downloads, it doesn't necessarily have to be a lot of downloads per episode, but just a lot of downloads generally on the podcast, then you start ranking. So if you start typing in passive income, like mine will come up before some others because I'm getting a lot of downloads generally. And if I have a lot of episodes, let's say I have 10 episodes with, 100 downloads each, that's a lot more than, just one episode with 200 downloads. It does kind of a ranking based on how many total downloads. So if you put a bunch of content out, a bunch of episodes, and you'll end up getting more cumulative downloads and you'll rank higher in the algorithm.
So what's your thoughts on somebody that, let's just say like yourself, I'm 50 episodes in, right? And would that method still work? Like, hey, if I dumped 10 episodes at the same time, you think?
So he actually, it's funny because, he told me to do that strategy with the caveat that he didn't even do it, right? When he launched his, he didn't do it. But he saw other people doing it and it worked. And what he did was what you can do is kind of, at some point there can be a stopping point, whether that's on the calendar year, or let's say you take, I don't know, maybe the first 100 episodes or the first 50 episodes, call that season number 1. And then whenever you launch season number 2, maybe build it up like I explained.
That makes sense. Okay. That makes a lot of sense because I know podcast is becoming basically the new radio. And, obviously when you can't read a book when you're driving, or you shouldn't be texting or reading, texting. So, radio or podcast, right? And there's over 2.5 million podcasts out there, whether they're consistent or not, that's up in the air, but that's how many is out there now. And there's so much content available now. I used to just listen to NPR and a few other radio, places. And then that's where you would get a lot of your content from, unless you were reading a newspaper or you went to a library, right? But now because of streaming, now I can listen to your podcast. I can listen to it on my phone or whatever and get all that information. So I think I have appreciated the evolution of podcasting, and I have a lot of respect for it because now, some people just started a podcast just saying, I'm just going to get a mic and just talk, has now kind of turned into like a particular niche that is actually pretty cool. Like, some people like, hey, all right, I may not make any profit for like 3-4 years, but it's fine. I'm doing what I love. And it's actually still a funnel, right? Because your podcast is a funnel to, let's just say, oh, wait, he invests in real estate. I like to invest. I like what he has to say on his podcast. Let me message him and let's do a syndication together, right? Yep. And that's actually happened to me where, somebody who I've talked to, who I interviewed was like, hey, let's do a deal together. And so it happens. Obviously you're up here to, help and put out as much content as possible, but it definitely helps in different indirect ways than what people would think.
Yeah, there's so many great benefits to it that you don't even realize it until you do it. Like you said, the networking aspect, just the people you interview and you meet through doing this, it's incredible. People that, might, not myself, but there are people out there that charge, $500, $1,000 an hour for their consultation, just to talk to them for an hour about, whatever it might be, real estate or marketing or whatever it might be. You can invite them on the podcast and talk to them for an hour for free. So the networking aspect is awesome. And I don't know about you, but I've just become a better speaker. I've become a better speaker and better at just small talk. Even when you're just BSing with your friends, you're just like more inquisitive because you're just used to like asking people questions all the time at this point.
No, you're right. And so, a little bit of backstory about me. I never liked talking in front of people growing up. I used to hate it when my teacher tells me to get up in the front of class and am I going to say the too much? Will people count how many I do, right? I'm going to stutter or lose my train of thought, whatever the case may be. And then as I transitioned and I joined the Navy, right? For us, as we go up in leadership, it's expected of us to be able to speak in front of people. And so that's when I was in charge of, it's a repair locker. That's where we fight our fires out of. I had to talk in front of like 100 people, and that was like a first for me. And everybody's looking at you, so you got like 200 eyes is looking at you. Every word that you say or don't say or use the wrong acronym, whatever the case may be. And so that's what got me a little bit better at being on YouTube, because like you, I didn't want to be on camera. And I remember when I did like this modeling course, like I didn't even like how I looked on the camera. I didn't like how it sounded, none of that. And so when I got up here on doing a podcast, I realized like, yeah, you're right. Like you do get better over time speaking. You do, it does help, right? So now, like, let's say you want to do a TED Talk, Seth. You're used to being able to talk and carry a conversation for 30 minutes and people looking at you and probably make a joke out of maybe you stumbling on a word or so,
Right. You're just more comfortable is what it comes down to. Like what you used to be afraid of before. Now you're just like, whatever. I've done it a million times at this point. Let's do it again. And if you screw up, you realize it doesn't matter.
and so I want to ask, man, so how do you have a plan to scale your podcast? What would be the next step for as far as where you're at right now for you?
Yeah, I mean, at this point, I need to do a little bit more. So I plug it on like social media all the time. I've got it up on YouTube. YouTube doesn't get any traction because I'm not doing it right, but I understand that. I do it on there anyways. But man, at some point you have to start, doing different things. And for me, I think I'm going to start doing some Facebook ads and start growing, start focusing on, who my audience, who they are. So you can focus those ads on the people that you're trying to reach. So for me, it's attorneys, it's doctors, it's engineers, folks like that. And you can focus those ads on them to try to funnel them into your show.
Awesome, man. I do appreciate you sharing that. So for you, who's your dream person you want to interview?
Dream person, man, it would probably be for my content, it would probably be Robert Kiyosaki. That'd be pretty incredible.
Yeah, mine's Robert Kiyosaki, and then I also would like to interview Denzel Washington. So because I cover he's big on like mindset and overcoming challenges, and then obviously the man who wrote the Purple Bible, Robert Kiyosaki. Definitely would want him to have him up here to see what he has to say, because he's very active. Hey man, shoot your shot. You may get lucky. It's funny how successful people, they're so willing to want to share information. So
yeah, for sure. I'm working on it. So I got a couple of the Purple Bible guys. Like I got Tom Wheelwright and some of their, the tax guy and attorneys and those folks. So I'm circling around.
Also, no, yeah, see that's how you do it. And I definitely would encourage podcasters like, hey, shoot for whoever you want and see what you can, and at the same time have fun. I didn't think about it till one of the other guys that I interviewed, he does a podcast, and he was like, how many you recorded? I said, well, I recorded like literally like at that time I had recorded like 25 episodes in like a week, but they were all staged out. And so he's like, man, you must really like what you do, because he's like, normal people just can't sit there and just record all that time in like a week or two. And I was just like, I didn't even think about it like that. It was just me just clocking, dialing in, talking to these individuals. I'm learning as my audience is learning as well. and really enjoying it. So I think your audience can tell when you truly enjoy what you do, you have a passion for it. Like for you, you said that it was originally geared towards attorneys, right? That was your passion. People felt that. And so when you launched it, it went crazy. And so you ever thought about doing a podcast course on how to have a successful podcast?
Man, I thought about it, man. Like I've got I owe it all to my buddy Adam Adams though, man. Like he's the king of it. He's got podcast courses and all this other kind of stuff. He's actually almost transitioned from real estate to just launching podcasts. So yeah, I've considered it. I mean, I had a pretty successful launch, so I've considered it, but for now, man, real estate's my game. So if anything, I'll launch a real estate course.
No, you're right. And so finally, man, because you obviously love what you do, you're pretty successful at doing it as well. Like what I like to ask is, what is your big why? As we like to say, what is your rich state of mind? Why do you do what you do?
Yeah, I mean, it's family. It comes down to having freedom, flexibility, and fun. That's what I like to say, because it's like, you've got to step away from that 9 to 5. You've got to step away from that day job so you can start having more freedom and more flexibility. And then once you have that freedom and flexibility, then you can actually become who you were meant to be. Once you get rid of that, once your expenses are paid for, you don't have to worry about the next paycheck. It just kind of opens up your mind. And for me, my why is just being able to spend my time the way that I want to. And that's with, my parents and my sister and my wife and my friends. Like, it's all about the people.
Awesome, man. Thank you for sharing that. You taught me a few things, man, listening to you. And it's always refreshing talking about real estate, by the way, and podcasting. So 2 things that I both do. So that kind of makes the interview real easy, because it's the stuff that I do as well. And as it's kind of been a theme without even really trying to do it. But since the last month or so, I've been interviewing a lot of commercial property, a lot of syndicators, because when I first started the podcast, because I'm on right now, episode 54 just came out. But when I first started the podcast, a lot of it was residential property, like starting a single family home, burring townhouses and stuff like that. And then now the podcast has kind of grown and transitioned. So I would like to think that, let's just say you started episode 1, you started off like single family home, turnkey. And then as the podcast has transitioned and grown, by the time you get to episode 50 or 70 something, now I'm comfortable doing commercial property. So that's kind of fun how that's kind of worked out. And like I said, man, I'm telling you right now, man, I love your interface on your podcast website. I'm gonna have to steal it. It's actually pretty dope. That's why I was like, who's your web designer, man? Because I like your setup. I like it when somebody has don't get me wrong, everybody may not have it all together, right? Because we don't know what happens behind closed doors. But I like it when somebody has a great presentation, professional presentation, a very prestigious look. And you may just have like your AirPod, the old earphones, iPod earphones, where you got the microphone like right here to your mouth. You gotta, may be talking like that the whole time and just be only audio, but nobody knows that because your presentation is awesome. So this is pretty cool, man. I really appreciate your time.
Appreciate that, man. Yeah, thanks for having me on, brother. Really appreciate it.
No problem.
Thank you for sticking with us from the start of the episode. Please share our show with friends and family, visit our YouTube channel, and view more of our content on richstateofmind.com. See you next week on the Rich State of Mind Show.